Well, hello everyone. This is Jacob Stein, and welcome to today's webinar on estate planning and asset protection planning under the new Tax Act. Your speakers today will be Michelle Lerman. I will introduce Michelle in a second, and myself. Michelle will start off by speaking about estate planning and estate tax planning under the new Tax Act, and I will then speak a bit about asset protection planning. So a couple of procedural notes first for everyone listening. If you want to ask questions of me or Michelle, please do so. You do have the chat window available to you in Zoom within the conference. So just message us your questions, and then we will answer questions at the end. We'll leave about 10 minutes to answer your questions. And I know some of you have been emailing us questions ahead of this presentation, so we wanted to save them to share with everyone. So please just email your questions. We'll be happy to answer any questions you have, so long as they're somehow related to this presentation. For the attorneys who are on the call, you will receive a CLE certificate from us automatically by email. If you're an accountant and you would like a CPE certificate, we are happy to provide one, but email us. We have those, but we need an email from you so we know who needs the CPE certificate. If you do not get anything from us at all, email us. We will gladly get you whatever you need. If you'd like a copy of either Michelle's slides for her presentation or my slides, again, shoot us an email. We are happy to share the slides with you. So let's start. Michelle Lerman, who practices both in San Francisco and Los Angeles, is probably one of the best known estate planning lawyers in this state. She speaks a lot, she writes, she has a book that she published recently called Create Your Best Legacy. I'm sure it's on the New York Times bestseller list, or it should be at least. She is highly personable, highly intelligent, and in my book, really one of the best estate planning lawyers in the state. And today, Michelle has the difficult task in the span of about 27 minutes explaining the new Tax Act and how it implicates and plays with the estate planning that we commonly do. So, Michelle, I am sure you are dying to get some things off your chest, so please go ahead.
Very good. Thank you for that lovely introduction. So I'm really excited to be here to speak on this topic. This is a historic Tax Act that was passed, that went into effect at the beginning of this year, 2018. And it raises a lot of questions. There's a lot we don't know, but there's also a lot that we do know. And what I'm going to talk about today is a quick synopsis of those aspects of the new Tax Act that will affect estate planning, or where estate planning offers some amazing opportunities, and also then explain what estate planning is available under the new Tax Act. And I'm going to actually give you 3 action steps, 3 action items that you can go ahead and talk to your advisors about and start thinking further about. So let's get started. Wow, what a historic Tax Act. Here's what's happened starting at the beginning of this year. The amount that you can transfer free of transfer tax, that means that you can transfer it during your lifetime or at death, has basically doubled. When I first started practicing law, about $275,000 is what you could transfer free of transfer tax. That means that if you died, $275,000, there was no estate tax, and anything over that was taxed. And the tax rate actually even got as high as 55%. So this is historic that we have roughly 11.2 million for an individual that you can leave when you die, or you can transfer it during your lifetime free of transfer tax. And that means 22.4 million for a married couple. The other changes in the Tax Act is we have a free gift. I call it a free gift. It's called an annual exclusion. It used to be $14,000. This year it went up to $15,000. That is a huge bonus. Basically means that an individual can leave $15,000 every year to as many people as the individual wants without any transfer tax. So if you have 10 grandchildren and 5 children, those are a lot of annual exclusion gifts that you can make. No gift tax return required, no gift tax on it, and it basically gets assets out of the estate, which is what you want to do if you're concerned down the road that you're going to have a taxable estate. So that annual exclusion amount, $15,000. The other interesting part of the new act that it may surprise you to learn that it has an estate planning benefit, that there's a way to use estate planning to help, is what's referred to as this 20% deduction for QBI, qualified business income. And we're going to talk about some planning opportunities and what exactly that deduction is. The other interesting issue is the $10,000 limit on the deductibility of what's referred to as SALT. Basically state and local tax. So that's state income tax, that's property tax, and this $10,000 limit. What's very interesting about this new law is that it sunsets. So at the end of 2024, this new law goes away. And we don't know, it might go away sooner. There could be a change in the administration in 2020. We really don't know. But we do know that this law for sure sunsets at the end of 2024, absent further congressional action. Let's go to our action items. First action item, you've got to review your current living trust. And the issue here I want you to focus on, if you're a married couple, does your trust provide for the assets to split into different shares at the first death? This gets kind of technical. We talk about survivor's trust, Q-tip trust, bypass trust. The bottom line is, do the assets split into different shares when one spouse dies? You definitely need to have a trust still, because that issue is probate, not estate tax, and a funded trust avoids probate. And face it, probate is very expensive. It's based on the gross value of assets. Doesn't matter what your loans are. Probate fees are based, the statutory fees you can see on the screen are based on the gross value, and they're expensive. You've got a $4 million estate and you've got probate fees of $53,000. That goes to the lawyer, and then $53,000 for the person serving as the executor. So it's quite expensive. Funding the trust, a simple living trust avoids probate. The issue, though, is that what kind of trust do you need? A trust is basically an instruction manual on what happens when you die or incapacitated, but what exactly should your trust say? Well, the typical living trust up till now has been a living trust like what you see on the screen. While both spouses are living, you've got all the assets inside the trust, and they split into 2 shares. You've probably heard of a bypass trust and a survivor's trust. And so if you had, say, $1 million here in the living trust, including your house and some bank accounts, and you split it at the first death, you'd have $500,000 in an irrevocable trust and $500,000 in a survivor's trust. Sounds simple enough, but it's the wrong kind of plan for 90% of married couples, because this $500,000 that's in this bypass trust, when the surviving spouse later dies, every bit of appreciation of the assets in this trust are going to be subject to capital gains tax. So creating this bypass trust actually created higher income taxes. Whereas if everything just simply went into the survivor's trust, the $500,000, if it increases in value by the time the surviving spouse dies to $1 million, you get something called a step up in income tax basis. And when the assets are sold, there's no gain, because it doesn't matter that the tax basis was $500,000 when you put it in. What matters is the date of death value of the surviving spouse. So it gets that nice step up. By the way, it could be stepped down also if there's depreciation. Typically, we look at appreciation because that's been more common. And so there's no income tax. But here you've created income tax. Why do I say unnecessarily? Well, let's step back a minute and remember that the whole reason we ever created this bypass trust was to avoid estate tax on whatever we put in the bypass trust, avoid estate tax when the surviving spouse died. It was to bypass the assets of the surviving spouse. Do we need that now? No, not for $1 million estate. A married couple can leave over $22 million without having this bypass trust. Your plan needs to be reevaluated. You can see from this next slide that this trust is very similar. It's a QTIP trust, QTIP, very similar. You've got an asset split half into a survivor's trust, half into an irrevocable trust. But this type of irrevocable trust, because of the tax provisions, we make a certain tax election when one spouse dies, and it does get that wonderful step up in income tax basis when the surviving spouse dies. So although it looks similar in structure, you've got two shares, it's a much better type of trust under the current law, that you don't need irrevocable trust like this if your assets are under the exemption amount. And for a married couple, that exemption amount in effect is over $22 million. What are some other options to consider? And this is why I want you to look at your trust. If you have a very modest estate, you have a marriage, long-time marriage, kids of the marriage, you're not worried about asset protection from creditors, you're not worried about your spouse getting remarried, this type of trust could be fine. You have a joint trust, everything goes to the surviving spouse in one trust, no division into shares. The problem there is that you really don't know what the surviving spouse is going to do, because the surviving spouse has full flexibility to change it. So it's really a balancing to figure, do you want a simpler kind of a trust that everything goes to the spouse, or do you want more protection? Because that ongoing trust protects assets. It could be a second marriage that you're worried about, a second spouse, could be a second husband, or a second wife, like I refer to as this sexy Sue. So the ongoing trusts really offer protection. This type of trust, again, I'm going back to the QTIP trust with the division, offers more protection. It's really a balancing act that I want you to consider. Should I have an all-to-spouse trust? Should I have a QTIPable trust? And it's not such an easy decision to make, because there are many factors to consider. Yes, the all-to-spouse trust is simpler, more flexible, but for someone who has a lot of real property and you want to qualify so that the real property taxes don't go up when the surviving spouse later dies, under the all-to-spouse trust, you only get one parent-child exemption. And that may or may not be enough to make sure that property taxes aren't reassessed when your kids inherit assets. So you really want to do a bit of a property tax analysis. The other issue is that if you leave assets in a dynasty trust that benefits grandchildren, you may not get both exemption amounts. And to simplify it, it basically means that if you go with the all-to-spouse trust, depending on the size of your estate, that might not be enough to properly shelter assets that you want to leave eventually to grandchildren. So a lot of factors to consider, and the QTIP trust gives more protection, might be better for estate tax. face it, this law is temporary. Remember that, it's temporary. What if the law changes and you are incapacitated or you didn't change your trust? If you have this Q-tippable trust option, the surviving spouse can do tax planning after one spouse dies. So this type of trust would be better at minimizing estate tax. And then the property tax issue could be important. You've got the protection and you've got all appreciation that is in that Q-tippable trust protected. So just to recap the first action item, do you want a trust that divides at the first death of one spouse, or do you want a trust that goes all to the spouse in an ongoing revocable trust? That's the decision that needs to be made. Action item number 2, this is for larger estates. We now have an amazing opportunity to transfer over $22 million out of the estate. And we don't know if the law is going to change, as I mentioned. So now is an opportunity for larger estates, if you're possibly worried about estate taxes, get the assets out of the taxable estate. How do you do that? You do that by transferring assets to irrevocable trust. So far, we've been talking about a living trust, which is a revocable trust. You can change it at any time. There are many, many different options for irrevocable transfers to irrevocable trusts, and I don't have time to go into all of them today, but I want you to look at what the options are. You could do a gift, you could do a sale, you could do a discounted transfer. That means transferring a portion of an LLC that owns real estate, for example, and that can leverage the amount that you can pass free of estate tax. It could be a grantor trust, where the grantor, the person who puts the assets into the trust, is continuing to pay the income tax. Or it could be a non-grantor trust, where the trust itself is its own separate entity that pays the income tax, and it's a separate taxpayer. It could be a completed gift. That's how you get assets out of your estate. And so it's not included when you die for estate tax purposes. But as we'll discuss in a minute, you might want to consider incomplete gifts. There's a place for those also, where you retain some control over it so the IRS doesn't look at it as a transfer for estate tax purposes. Lots of options and lots of benefits. You take highly appreciating assets, get it out of the estate so that it basically freezes the value and the assets grow in the irrevocable trust, not in your estate. There's protection. You want to make sure, and Jacob is going to talk more about this, the benefits of irrevocable trust for adding protection. You can transfer assets in a dynasty trust so that when your children pass away, it transfers at their demise without any transfer tax, so transferring it to future generations. Let's say that you have a child who needs the down payment for a house. By putting assets now in an irrevocable trust, you can make tax-free distributions to the child, let them buy a house in their own name or in the name of the trust. If it's a grantor trust, then the grantor even pays the income taxes on the trust, and that's another tax-free gift. Think about it. It's a way for the grantor, if you're putting money or assets into an irrevocable trust, to get more out of your estate and not subject to estate tax. The downside, there is the loss of the step of an income tax basis at death, so you want to carefully look at that. Third action item is to consider income tax planning with trusts. That is something previously we hadn't considered much about, income tax planning. It was there, we had methods of doing it, but now because of changes in the tax law, we really want to start looking even more at what estate planning can I do to minimize income tax. I'm going to give you a couple of examples. Let's talk about how to shift income out of California. By using something called an ING trust, I-N-G trust, we can transfer assets out of California and into a trust in another state that doesn't tax the trust income. There are 7 states that don't tax trust income: Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming. I typically use trusts out of Nevada. And the idea is that you transfer assets to an irrevocable trust. It's a non-grantor trust. So remember, that means that the trust itself is a tax-paying entity that's going to be paying the income tax. You have an out-of-state trustee. So that is what in part makes this a non-California trust. So you use a Nevada, for example, trust company. The trust has to be in a no-tax state, and it has to be an incomplete gift. So a ning is a very, or an ing if it's in a different state, if they call it a ding, if it's in Delaware, is a very interesting way of transferring assets. There are limits. You can't have California source income in an ing trust. For example, you couldn't move a California apartment building into an ing trust, because California says that if it's a California property, that it's going to be taxed in California even if you use an ing trust. But there are situations where an ing trust can transfer out the income tax. And the reason I'm talking about this is now it's such a big issue that California income tax isn't deductible, completely deductible on the federal tax return. So California tax just got even more expensive. So that's why we're talking about shifting income out of California. There's that limit that I discussed at the beginning of only $10,000, and that includes your income tax in California and your property tax. So in addition to looking at ways to get around that SALT limitation, the state and local income tax, the fact that it's not all deductible. The other amazing opportunity is Internal Revenue Code section 199A for this qualified business income deduction that I spoke about. What I want you to know about the 199A deduction is that there are income limits. And so the idea, the whole crux of planning right now, the heart of planning is managing the taxable income and these other limitations so that you can qualify for this 20% business deduction. It basically, what it does is if you are, and that's a defined term, QBI, qualified business income, if you have qualified business income, it basically reduces your marginal rate to 29.6% instead of 37%. That's really big news, and that's really valuable. The problem is that if your assets, or if you're married and your taxable income is more than $315,000, either you don't get this deduction or it's phased out. And if your taxable income is greater than $415,000 and you're a service business, you don't get that deduction at all. We are finding right now the best strategy that we are considering now is to take an apartment building, which, by the way, is a qualified business income. You take an apartment building, you put it in an LLC, you transfer the LLC into a trust with, say, 10 grandchildren as the beneficiaries. And what you're basically doing is that trust is irrevocable. It's a non-grantor trust, and you're basically dividing up income between taxpayers so that each taxpayer can qualify for this 20% qualified business income deduction. Really exciting news. There's going to be more regulations on this, and so you want to be sure to work with your tax advisor before doing any sort of planning. But I have to say we're very, very excited about using trusts to manage the limitations imposed by the qualified business income deduction. Wow, we have covered a lot in 25 minutes, how the new tax doubles the amount that can be left free of estate tax, how you can do it during your lifetime, not only at death, and all of the planning opportunities to take advantage of because this law is temporary. So that concludes my part of the presentation. And Jacob, I'm going to turn it over to you.
Well, thank you, Michelle. It was a great presentation. I have actually learned a lot. Guys, as a reminder, if you do have questions, we are happy to answer your questions. Some I've already saw were being submitted. We have about 100 people listening in, so I'm sure there'll be lots of questions as we continue. So feel free to ask questions through the chat box. So let's continue with the presentation. And before I move into asset protection, I just want to kind of stress a couple of things that Michelle said so well. One is that because of the new tax law, and because of the huge exemption we have available to us currently, by all means, make sure that your clients are taking advantage of this huge exemption. The exemption sunsets, as you likely know, and there is a clawback provision in the new law, meaning that if your client ends up dying after the exemption goes down and they've used the currently high exemption, the government is supposed to claw back this additional benefit that the taxpayer received. Now, most commentators, myself included, believe that there will be, from a practical standpoint, no clawback. Many commentators believe that kind of as a policy matter, the government is not going to claw back prior tax savings because there's just this usually taxpayer rebellion associated with imposing taxes retroactively, and this in effect would be a retroactive tax. The other point is that, and what I believe is that from a practical standpoint, it's going to be really tough for the government to claw back the savings because they're going to ask a question on a 706 saying, have you used the deduction, an exemption larger than what is currently allowed? And most people will simply just say no, and that's that. So I would use the exemption today. And because we are seeing more and more clients, taking advantage of this huge exemption that we have today, the estate tax planning that we are doing in our office has changed, I think, in a fairly significant way. Whereas prior to this act, we were looking at structures like intentionally defective grants or trusts, and grats and valuation discounts, sort of all the standard estate tax planning structures that you have all seen and many of us have grown up with. Today, because of the large exemption, we're often saying, let's forget all of that. Let's forget the annual gifts to the trust. Let's forget, slowly getting assets into structures using valuation discounts, and just make an outright gift. Make an outright gift to an irrevocable trust and get as much as you can out of your estate while you can do it. The law sunsets technically, when is it, in 8 years or so? I forget the exact date. But there is this discussion out there among the commentators that, look, it's possible that in 3 years when the administration changes, perhaps they will pass a new law at that point in time. And then we're back to lower exemptions and so forth. And certainly on the left, there is no affinity for reducing or eliminating the estate tax, right? So if tomorrow we have a Democrat in the White House and we have a maybe democratically controlled Senate, we're going back to having an estate tax. So use it now. Now, you still can use all the old estate tax planning tools we had yesterday. We can still use intentionally defective grants or trusts, right? And remove all the future appreciation out of the estate. We can still use valuation discounts that are associated with legal entities, and by all means use those as well. But at the same time, do not be concerned with making taxable transfers because you do have a large exemption to cover them. So I'll give you a quick example. We have a client right now where we are planning an estate. It's an elderly client. He is married, and the estate is about $40 million. Now, with the traditional planning, we would start getting business assets into an FLP type structure to get valuation discounts. And we would claim the valuation discount today for making the gift. We would then claim a valuation discount for the interest that the client still owns on that. But this is a much older client. His, I think, life expectancy is about 5 years. So realistically, with a business that large, with that much value, how much can we transfer out of his estate and to the kids, or to a trust for the benefit of the kids, to then get a meaningful valuation discount on that? Likely with just kind of these smaller annual gifts, the client will still own like a 95% interest when he dies. That doesn't work so well. So what we're doing is we're taking a huge chunk of this business and making a taxable gift into an irrevocable trust for the benefit of the kids, with the idea being that now on death, the client owns less than 50% interest in this business. So for estate tax purposes, we get a much larger valuation discount. So again, and I cannot stress this enough, make lifetime gifts. Do not be afraid to make lifetime gifts and use up the lifetime exemption, the 11 million or so per person that is currently available. And the clawback, I wouldn't worry about it. If they do claw it back, no harm, no foul, but there's a good chance they will not. So use it. I agree with Michelle that we're seeing much greater use and a lot more interest in structures like dings and nings. These are the intentional non-grantor trusts that Michelle referred to. Ding stands for Delaware. Ning stands for Nevada, but you can set it up in any of the 7 states or so that do not tax income of a trust. And certainly for those of us who live in a high income tax state like California, and especially given that we lost the SALT deduction, or it's limited to 10,000, which is equivalent to losing it for a lot of our clients, we need to get out of California from an income tax standpoint. So these trusts are now even more popular than they ever were previously. We're seeing the use of these trusts, and we've been using these trusts for years. We're seeing these trusts used when a client is looking to sell their business in the future. So we did a transaction, for example, recently, where a client invested in a startup, and when they came to us, their investment in the startup was worth about $5 million. But the client expected that in a couple of years, the company will go public. And if the company goes public, their $5 million interest will become a $30 million interest. And they would then want to sell it and realize the $30 million gain. And the $30 million gain, because the client is a California resident, would be subject to the federal tax and the California income tax. So what we did is we set up a thing. In his case, it was a Nevada non-grantor trust. And he sold the shares in the company for its $5 million value in exchange for a promissory note to this trust. So now the trust owns the shares. The trust has a $5 million basis. The client has installment sale treatment on this $5 million sale. The company ended up going public. He sold his shares for close to $30 million. It wasn't quite $30 million, but it was fairly close. And the tax was paid only to the federal government, because this trust, the current owner of the shares at the time of the subsequent sale, it's not a California taxpayer. The trust owns an intangible asset, shares of stock in a corporation, and intangible assets are sourced to the jurisdiction where their owner is located. And this was a Nevada trust. So the client completely avoided the state income tax on the difference between the sale price, let's say 30 million for simplicity's sake, and the $5 million basis that the trust acquired in the stock. So that $25 million times 13%, it's a fairly significant tax saving for a simple structure like, hey, let's move an asset into a trust. And it's really not a very complex structure. You set up a trust, you set up a purchase and sale agreement, promissory note, and you get a very nice tax result. So certainly for residents of California, New York, and other high income tax states, we'll be seeing a lot more of dings, nings, and the like. Then there's a question on the chat platform. What do we do if all the beneficiaries are California residents? So California, as you may know, takes a very aggressive position, just globally, right, for tax purposes, and it certainly takes an aggressive position for these ING trusts. In California provides that if you have a trustee that's in California, you have beneficiaries in California, we will continue to tax the income of the trust, but that's only true if the settlor of the trust is a California resident. Like imagine someone in New York State sets up a non-grantor trust. California would have a difficult time taxing that trust just because beneficiaries are here, so long as it's a complex trust, so long as we're not distributing all of the income currently. So how do we avoid having the client become the settlor of one of these ING trusts? Well, you do what we did in the example I just gave you. Instead of having the client fund the assets into the trust via gift, we will have the client sell the assets to the trust. And we'll usually use some sort of a third-party designee as the initial settlor of the trust. And they're a settlor sort of a nominal capacity. And the client is just a seller. He's selling this $5 million of stock to this trust, and he's not reflected as a settlor, and he's not treated as a settlor of the trust. And that allows the trust to have California beneficiaries. What we also do, and that's sort of the beauty of the modern trust drafting, is we are using protectors for almost all of our irrevocable trusts. And one of the powers we can give to the protector is the power to change the beneficiaries of the trust. So if we needed to, for whatever purpose, for asset protection purposes, for tax planning purposes, or whatever else, to have non-California beneficiaries, we can do that. We can set up this Nevada trust and name Donald Trump as the beneficiary of the trust. Doesn't mean we need to make distributions to him. It does not mean that on the client's death, he will actually receive the money. It just simply means that we will change who is the beneficiary at a later point in time, right? Or we can provide that on the client's death. The remainder beneficiary is not Donald Trump, but it's the client's children who do live in California. But today, we can easily avoid having California beneficiaries with some, let's call it clever drafting. What else is popular following this new tax law? I think you will see a lot more SLATs. SLAT stands for Spousal Lifetime Access Trust. This is when you have two spouses set up what effectively would be reciprocal trusts for each other's benefit. So the husband, let's say takes $1 million of assets and puts it into a trust for the benefit of the wife. And the wife takes $1 million worth of assets, puts it into a trust for the benefit of the husband. The kids are the remainder beneficiaries on death. These trusts allow our spouses to remove the assets out of their estate. The kids are the remainder beneficiaries, but to retain access to the cash flow from the assets, because the other spouse is the beneficiary. Their beneficial interest is limited by what's called an ascertainable standard, meaning we can only distribute to them for health, education, support, and maintenance. But practically speaking, health, education, support, and maintenance, it's in the discretion of the trustee. This is not something that gets audited by the government. So we can get quite a bit of money to the other surviving spouse. Have to be very careful how you set up this trust. First of all, it cannot actually be a reciprocal trust, because under the reciprocal trust doctrine, when you have two people set up identical trusts for each other, the trusts will be ignored, almost like on an alter ego grounds. And the other thing to worry about is that in a state like California, we cannot contribute community property assets to a spousal lifetime access trust, because if we are contributing community property assets, each spouse is deemed to be a settlor of the trust. they're also the beneficiary. The assets are included in the estate. Someone asked me, am I intentionally still on slide number 1? And the answer is yes. Pretty much everything I do is intentional, including this. So I'm still kind of going over some of the estate tax uses of the new tax law, which I think is a little bit more interesting than asset protection. But since you guys asked, let's move on to asset protection planning. And I'm trying to open it. Right, we go some Q&As that came up. One is, can we download the slides? And the answer is no, but as I mentioned earlier, we are happy to email them to you if you request them. And is Jacob using slides? Yes, and you should be able to see them on the screen right now. All right, so asset protection planning, and again, so we have a number of slides here. I'm happy to share them with you. Asset protection has not been changed in a direct way by the new Tax Act because it is a tax act, and asset protection is always tax neutral. Asset protection has changed a bit because the new tax law makes it beneficial for us often to use irrevocable trusts. And irrevocable trusts really are the heart and soul of asset protection planning. And given that we already spent so much time talking about trusts, let's focus the remaining, let's say, 10, 15 minutes talking about how we use trusts for asset protection planning. And often it will be these trusts that Michelle has described and I have described, you know, the trusts that are commonly used for estate tax planning, that are nowadays used for state income tax planning and the like. So the primary purpose of asset protection planning is to remove our client from the ownership of his assets. If our client owns his assets, a creditor can reach those assets. If our client does not own the assets, then a creditor cannot reach those assets. So pretty much every single asset protection structure aims to do the exact same thing. Take an asset that our client owns and make it into an asset that the client does not own. Which is not that difficult to do if you think about it. I mean, you can tomorrow take all of your assets and donate them to the Salvation Army. And once you've done that, you will no longer own those assets. But you truly will not own those assets, right? You will never see them again. And likely that is not what most of us want to do, not what most of our asset protection clients want to do. So the tricky part is that we want to make the assets not ours in such a way so that we retain control over the assets, we retain the ability to transfer the assets back to our name tomorrow, and often we want to engage in those transfers without tax consequences. Although maybe now with this new tax law, that is also a bit different and has changed, and we may want to have completed gifts of assets a lot more often. So how does a trust help us? Well, if we transfer assets to a trust, to an irrevocable trust, our client no longer owns those assets, right? The title of the assets is now vested in the trustee of the trust, and not in the name of our client. But it's an irrevocable trust, you say. It's an irrevocable trust. How does our client then get access to the assets that were put into the trust? How does he retain control, the ability to use these assets tomorrow? It's done the following way. So if you look at a traditional irrevocable trust, like the irrevocable trust that we've had access to over the past 400 years or so, these trusts were truly irrevocable trusts, right? Truly irrevocable trusts. So we had no ability to access the assets placed into the trust. We just could not. So that, you know, and that's where sort of the reputation of irrevocable trust developed from you know, Victorian era England, maybe even before, I think maybe during the reign of Elizabeth, where it was an irrevocable grant of assets into the trust for the benefit of whoever, and once you place the assets into the trust, they're gone. That is no longer true, or at least it does not have to be true today, because today very often we will utilize first of all, the concept of the trust protector, and the trust protector does allow us to retain a lot of control and a lot of flexibility over the trust. The trust protector is a non-fiduciary appointment. It's a position we create within the trust in addition to the trustee, but this position serves in a non-fiduciary capacity. And we give this trust protector certain very broad powers, usually. We can give the trust protector, as I mentioned earlier, the power to change who is the beneficiary of the trust. We can give the trust protector the power to change the trustee of the trust, to change the governing law of the trust. The trust protector can revoke the trust and return the assets to the settlor. The trust protector can terminate the trust and accelerate the distribution of the assets to the beneficiaries of the trust. Change any provision of the trust agreement. Maybe switch between grantor and non-grantor status. I mean, so all these things become possible through the use of a trust protector appointment. And what our client, the way our client sort of indirectly controls all this, is our client retains the power to appoint the protector. He cannot make himself the protector, but he can appoint some independent third party as the protector of the trust. So effectively, the assets of the trust are always within the control of our client. So that's number one. We use the trust protector to greatly get back the control and access to the assets of an irrevocable trust. In addition to the trust protector, we've realized that an irrevocable trust has a very, very narrow definition. If you look at the state law statute, if you look at the Uniform Trust Code, an irrevocable trust is defined as a trust where the settlor of the trust, settlor is the person who transfers assets into the trust, where the settlor of the trust has not retained the power to get his assets back. Because it's a fairly narrow definition. The settlor has not retained the power to get his assets back. Think about how a traditional irrevocable trust is drafted. It is drafted to say something like, this trust is irrevocable. And when you say this trust is irrevocable, no one can transfer the assets from the trust back to the settlor. So by narrowing it to say that only the settlor does not have the power to get his assets back, what does that allow us to do? Well, it allows us to appoint someone else who will hold that power. Perhaps the trust protector, perhaps another person. Okay, so irrevocable trusts, they're overwhelmingly used in both estate tax planning and asset protection. They allow us to do a lot more than what we can do with the standard revocable living trust, which just allows us to avoid probate and plan for incapacity. So let's assume that we have an irrevocable trust. What are the features of an irrevocable trust that we need to look for to have asset protection? So to have asset protection, again, the trust needs to be irrevocable. We just covered that. The trust should contain a spendthrift provision. And, I think today's spendthrift clause in a trust is boilerplate. Pretty much every trust I've ever seen in my entire practice has had a spendthrift provision in it that may be malpractice not to include a spendthrift provision in the trust. And we want a trust that is discretionary, which means that the trustee is given broad discretion when it comes to making distributions. And there's only one other feature I would add to these, is that we do not want, at least in California and in most states in this country, we do not want a trust that is what's called self-settled, meaning the settlor sets up the trust for his own benefit. And here I transfer $1 million to the trust, and I remain the beneficiary of this $1 million, or I somehow retain access to that $1 million. It has to be for someone else's benefit. That used to be a concern because who will be this other person for whose benefit we will set it up? It is no longer the concern because we always, through the protector, retain the ability to change the beneficiaries of the trust. So every single trust we've discussed so far today, or at least mentioned in passing, whether it is, let's say, the bypass trust that comes out of a living trust on the first death, or an intentionally defective grantor trust, a GRAT, an ING, a SLAT, all of these four-letter abbreviation trusts, all of them are great asset protection trusts because they all sort of tick these boxes that for someone else's benefit, and the trust is irrevocable, and it has a spendthrift clause, and it's up to us to determine how much discretion is given to the trustee to make distributions out of the trust. What sort of assets can we transfer to an irrevocable trust to protect assets from claims of creditors? There is no restriction. The trust can own pretty much any asset you can imagine. It can own real estate, it can own a business, intellectual property, and everything else in between. But there are some limitations from a practical standpoint. If we are, let's say, transferring an income-producing asset into a trust, and someone other than us has to be the beneficiary, what happens to the cash flow that the property generates? Right, so the property generates cash flow. The cash flow will go into the trust's bank account, and then who can we distribute it to? Well, we can no longer distribute it to our client, the settlor of the trust, because the settlor cannot be the beneficiary. And if we do distribute somehow to the settlor will be treated as a de facto beneficiary of the trust, and the asset protection is gone, and the assets are now included in the settlor's estate. And we perhaps do not want to distribute to the kids, right? Maybe the kids are young, or maybe the kids are inept, and we do not want to give them the assets. So that presents a wrinkle in the use of irrevocable trust. We primarily tend to use irrevocable trust for non-cash flowing assets, for non-income producing assets, like, let's say, personal residence. And I would say that every single year for our clients, we set up a few hundred irrevocable trusts just to hold their personal residences. It's a structure that I think is fairly straightforward as far as the setup. There's no property tax reassessment if you do it correctly. There are no income tax consequences if you do not want to have income tax consequences, although perhaps under the new law you may want to. And I've heard some talk from other practitioners about using non-grantor irrevocable trusts as a means of doubling the $10,000 sold deduction. Although I don't know how meaningful that would be to many of our clients to double $10,000 deduction. So personal residences very frequently use these trusts. If we have cash flowing assets, we sometimes will consider bifurcation, meaning maybe a portion of the cash flowing asset will be owned by this irrevocable trust, and that portion of the cash flow will get trapped within the trust. And the client will either directly or through a simpler mechanism own the remainder of the asset, and the client will receive the remaining cash flow that the asset is throwing off. Sometimes we will use irrevocable trust to own liquid assets, and when a trust owns liquid assets, something that we will consider is setting up the trust in a foreign jurisdiction. So why would we want to set up a trust in a foreign jurisdiction, given that we can set up a trust in the United States and it will do such a great job of protecting us from credit claims? Well, the answer is that if we set up a trust overseas, and we can then transfer assets overseas, which necessarily means the assets are in liquid form, the protection is greatly enhanced, infinitely enhanced. Because now, if you're a plaintiff or a creditor, what do you need to be able to do to get at our client's assets? You need to be able to litigate against this trust in some foreign country that you likely have never heard of before and cannot find without Google Maps. And the asset itself is outside of the United States. U.S. judge has no jurisdiction over that foreign asset, and you now need to go and collect, against some European bank that has an account in the name of some sort of a trust or some other more complex structure. In practice, I have found that these offshore trust structures, and there are many variations of them, are exceptionally effective. I mean, they're so effective that of the hundreds upon hundreds of times that I've set up offshore structures for clients, I have never once seen a creditor challenge an offshore structure. That is not to say that it doesn't happen. It happens, and I know I have some friends who, are also asset protection attorneys who have seen it happen, and it gets discussed in the community, but it's exceptionally rare. I mean, I have probably one of the busiest asset protection practices in the country, and I've never seen it in all the 20 years I've been practicing asset protection. So asset protection is, using offshore structures is probably the highest level of protection we can achieve for our clients. But you do need to have liquid assets. If we are protecting real estate, an offshore structure is not going to do us much good because we don't have a shovel large enough to move the real estate out of the country. Okay, that's really all I want to say about asset protection. I think you guys got a good sense of how the new tax law has impacted both estate planning and estate tax planning and asset protection planning. You will see a much heavier use of irrevocable trusts. You will see a lot more non-grantor trusts, which means for the accountants on the call, a lot more income tax returns to file, a lot more 1041s to file for non-grantor trusts. And we will be seeing a lot more completed gifts, so a lot more 709s to file. So again, guys, please, if you'd like either a CPE certificate or a copy of the slides, shoot us an email, send us an email instead of giving it to us through this Q&A platform. We have no way of responding to an email that you give to us through a Q&A platform. So email us. You all have our email information from the seminar registration materials you have received. So let's see if there are any questions we haven't answered. Can an S corporation stock be in a spousal access trust? Would it qualify as a QSST? I think a spousal access trust can be drafted as a QSST. I don't recall if I ever had the chance to draft one to qualify as a QSST, but I don't see why we would not be able to structure it that way. I think we've answered other questions.
Jacob, can I interject?
Of course, always.
First of all, that was absolutely awesome. Very, very informative. Thank you very much for that, all of that great information. A few people have asked for my contact information. My email address is michelle@lermanlaw.com. That's MICHELLE @LERMAN, lermanlaw.com. That's an easy way to reach me, or feel free to give me a call.
Thank you, Michelle, and that's a good reminder. Both Michelle and I are practicing attorneys, and we do work for a living, and we always appreciate your referrals. And I know that a lot of the people that we work with across the state are on this call, so thank you guys for all your past business. We do have a couple questions remaining, but we are out of time. So perhaps we'll kind of wrap up and then we'll answer the questions in a more private way. We will be doing other webinars, both Michelle and I jointly and separately on some related subjects and some other subjects. So please stay tuned. We'll keep announcing them. And if any of you are interested in co-presenting with one of us on a topic that's interesting to you and we may overlap on, please reach out to us. We are always happy to do so, and both Michelle and I are capable of providing CLE and CPU to the listeners, and that may be an interesting way for us to work together. So with that, thank you everyone for participating in today's call, and we'll see you next time. Take care.
Thank you, everybody. Thank you, Jacob.